Now, let's be clear, for the best in the industry, for the people in this room, this isn't new. This is just how you run your business. But for others, for those who free ride on your reputation, the age of irresponsibility is over.
The annual Mansion House dinner hosted by the Chancellor of the Exchequer and the Governor of the Bank of England is often pretty newsworthy these days. But Wednesday's event and the speeches delivered by George Osborne and Mark Carney made more waves than most. While the Chancellor revealed that the reprivatisation of the Royal Bank of Scotland would start within a matter of months, Mr Carney unveiled the findings of the Fair and Effective Markets Review. Caroline Binham, the FT's financial regulation correspondent, is with me to explain the so-called FEMA reforms. Caroline, welcome.
Thank you.
So what is FEMA all about?
FEMA is a year's worth of work that is attempting to put an end to this string of city scandals that we've seen, such as LIBOR and Forex rigging, such as some of the mis-selling scandals as well, but specifically focusing on the fixed income, currency and commodities markets. The idea being that these scandals and multi-billion pound fines that we've seen really weigh not only on the reputation of London, but they're also detracting from wider efforts by regulators to bolster banks' balance sheets in the wake of the financial crisis.
Now, a lot of these problems obviously were able to happen because there weren't very strict rules in place. FEMA is partly about filling the gaps in the rules, but it's also about a bit of self-regulation as well.
I think so. I mean, there has definitely been an attempt through the review to close up the so-called regulatory perimeter, close up loopholes, let's say. So things like spot FX, which after all is one of the world's biggest financial markets, weren't regulated very closely, and that's now going to change. Spot FX is now going to be within the market abuse regime, so those are the laws that stop market manipulation and insider trading, for instance. So that's part of it. Another key recommendation is that this market panel be set up. And that perhaps does smack a little bit of self-regulation, even if the bank and the Financial Conduct Authority are very loath to say that. They would say that it's an extra line of defence for the market to discuss amongst themselves emerging risks and also what constitutes best practice.
So from the industry's point of view, maybe it's a reasonable outcome, but it is another set of rules. It's yet more regulation. Are we reaching a kind of tipping point finally with, will this end?
Martin Wheatley and Manoush Shafiq, who are two of the chairs of the review, told the Financial Times that it's actually an inflection point, is how they see it. They wouldn't necessarily go as far as saying it's the high watermark of regulation, but they see it as the beginning of a dialogue with industry about changing culture. So there's a recognition that these 9-figure fines for misconduct problems aren't enough to change behaviour by themselves. It's just written into a cost of doing business. So for things to change, there really has to be a change in the culture as well.
Now, one of the key things that they are hoping, as you mentioned, Manoush Shafiq, who is the Deputy Governor of the Bank of England, or one of them, Martin Wheatley, head of the FCA, the Financial Conduct Authority, they're hoping that these UK reforms, given that this is a very global market, will be adopted internationally. What chances do you see of that?
I think the great hope that we have on our side is Mark Carney, Governor of the Bank of England. So clearly this has been a major project for the bank within its domestic remit, but also Carney is chairman of the Financial Stability Board, and that is the global standard setter that makes recommendations to the G20 countries. And one of its key priorities this year that it's already set for itself is leading the international response to the UK's proposals under this review. So Carney, I think, clearly can lead the charge. Martin Wheatley, meanwhile, and the FCA more generally are very involved in IOSCO, which is the securities watchdog global umbrella group. They're meeting next week in London, and I think particularly trying to pin down a global code of conduct for FX is one of their key priorities.
I suspect there will be resistance in some parts of the world, but at least they've got a decent platform, or a couple of decent platforms, to fight their battles.
Absolutely, and Mark Carney puts the can into Canada.
And a final point, how do they measure success?
This isn't about putting heads on spikes, so they say. The whole point of this is that there has almost been too much enforcement and not enough in trying to prevent the behaviours that result in enforcement. So for them, they would say that success is not necessarily traders doing perp walks because they've been arrested and going to jail, or heads on spikes, as it were. It's actually about getting to a point where culturally traders feel that they shouldn't be taking this kind of risky behaviour that pushes the envelope too far. I mean, if you talk to regulators, a lot of the time they draw an analogy with drink driving, and how over the last few decades there's been a cultural shift to it, first of all being acceptable, then saying, oh, well, I better not do it just in case I get caught, to nowadays actually it being seen as culturally unacceptable to drink drive.
That's probably taken about 30 years. That's the trouble.
Yeah, absolutely.
Caroline, thank you very much.
Thank you.